Welcome back to the Deep Dive. Today we're going to be looking at value investing and AU Small Finance Bank in India.
Okay.
Two things that you are very much interested in.
Yeah, definitely.
And we're going to be using excerpts from The Intelligent Investor by Benjamin Graham.
Okay.
And we've got some commentary on that as well.
Yeah.
As well as some marketing materials from AU Small Finance Bank.
Sounds good.
It's kind of like mixing peanut butter and chocolate, right?
Yeah, I like that analogy.
Two great things that might just go great together.
And you're right, we often see these topics in separate silos, but today we're going to break down those walls and see if we can apply the wisdom of a legendary investor to a modern financial institution.
Okay, let's unpack The Intelligent Investor.
Sure.
First, it's hailed as the Bible of value investing, but what does that actually mean?
Sure.
I get that it's about finding stocks that are worth more than their price tag.
Right.
But how do you actually figure that out?
So you've hit on the core concept, intrinsic value. Imagine you're buying a used car. The sticker price is what the seller wants.
Okay.
But the intrinsic value depends on things like its condition, its mileage, and how long it's likely to run. Graham argues the same applies to stocks.
Okay.
Don't just look at the market price, dig into the company's assets,
Okay.
earnings, and future potential.
Yeah.
That's how you find those hidden gems the market might be undervaluing.
So it's about thinking like a detective, right? Looking for clues that others might have missed.
Exactly.
But we found some debate online about whether this book written decades ago is still relevant today. Some think it's outdated, while others swear by its timeless principles.
Yeah.
What are your thoughts on that?
It's a valid question. Markets change, technology disrupts industries. However, human psychology, that's been around forever.
Right.
Fear and greed driving investment decisions. Graham's book isn't about giving you a stock-picking formula.
Right.
It's about teaching you a mindset that helps you navigate market ups and downs.
So it's less about specific tactics and more about a philosophy for making sound financial choices.
Exactly.
Okay, that makes sense. But let's get into some specifics. One of the things that stood out to me was Graham's idea of margin of safety.
Okay.
It sounds like a good thing, but
Yeah.
can you break it down for us?
Sure. It's one of Graham's most powerful concepts, and it's about acknowledging that we can't predict the future perfectly. The margin of safety is essentially buying a stock for less than its intrinsic value,
Okay.
giving you a cushion in case your calculations are off or unexpected events occur.
So it's like having a financial safety net.
Think of it like buying a house with a strong foundation.
Okay.
You might not see it,
Uh-huh.
but it's there to protect you if things get shaky.
That's a great analogy. Now, I know Graham also had some formulas for calculating intrinsic value.
He did.
Do we need to pull out our calculators and become financial wizards to use these?
Not at all. But to give you a taste,
Yeah.
one of his key formulas looks at a company's earnings per share, how fast those earnings are growing,
Okay.
and compares it to the stability of bond yields. It's basically a way to see if the stock market is valuing the growth potential fairly.
Okay.
We won't get lost in the numbers here, but it shows that there are concrete methods for evaluating a company's worth beyond gut feeling.
Interesting. It's like having a roadmap instead of wandering around aimlessly.
Yes.
But beyond the numbers, Graham also delves into the psychology of investing. It's fascinating how our emotions can mess with our financial decisions. What were some of his key insights on that front?
Well, he famously said, the investor's chief problem and even his worst enemy is likely to be himself.
Wow.
It's so easy to get caught up in the excitement of a rising market
Right,
or
yeah.
panic when things go south.
Yeah.
Graham stressed the importance of staying disciplined, avoiding emotional decisions, and thinking long term.
I've definitely been guilty of making impulsive investment choices in the past.
I think we all have.
So this idea of having a rational plan and sticking to it really resonates with me.
Absolutely.
Now let's shift gears and talk about AU Small Finance Bank.
Yeah.
They offer quite a range of services from your typical bank accounts to loans for homes, cars, even gold.
Interesting.
And they even have this program called Royale.
Okay.
It feels like they're trying to be everything to everyone. What stood out to you about their offerings?
What's fascinating to me is their focus on digital banking solutions.
Okay.
They've got the AU0101 app, WhatsApp banking, even banking via missed calls.
Wow.
They seem to be targeting a digitally savvy customer base, which is smart considering the rapid technological advancements in India.
Right.
And one product that caught my eye was their AU Green fixed deposit.
Okay.
It seems like they're tapping into the growing interest in sustainable and responsible investing, which could be a good sign.
Right. So we have a company that's both rooted in traditional banking services, but also pushing the boundaries with innovative digital solutions.
Exactly.
Now, the big question is, how do we connect all of this back to value investing? How would someone with Graham's mindset approach a company like AU Small Finance Bank?
That's where it gets really interesting. Remember, we're not giving financial advice,
Of course.
but let's put on our intelligent investor hats for a moment.
Okay.
We'd want to analyze their financial health, just like we talked about with individual stocks.
Uh-huh.
How are their earnings, their assets compared to their debt?
Okay.
What's their growth potential, and how do they stack up against competitors?
Okay, that makes sense.
Sure.
We're looking for clues to their intrinsic value.
Right.
Those underlying factors that might not be immediately apparent from just glancing at their marketing materials.
Exactly.
But what about the margin of safety concept?
Hmm.
How does that apply to a whole bank, not just a stock?
That's where things get a bit more nuanced.
Okay.
Instead of a clear-cut calculation,
Right.
we might look at the bank's history of navigating economic downturns.
Okay.
The quality of their loan portfolio.
Oh,
Are
right.
they lending responsibly? And their capital adequacy ratios. Essentially, how well prepared are they for the unexpected?
So it's about assessing their resilience,
Exactly.
their ability to weather storms. This is starting to feel like a detective case, peeling back the layers and looking for those hidden strengths and potential weaknesses.
It is quite a case, isn't it?
It is.
And Graham would be proud of this approach he always stressed, looking beyond the hype.
Right.
Just like those flashy marketing brochures we see from banks.
You know, it's funny you mentioned that. I was flipping through AU's website and noticed they emphasize this Royale program a lot.
Okay.
It seems like they're targeting a more exclusive clientele.
Interesting.
Does that align with the value investing approach, or is it more about marketing fluff?
That's a sharp observation.
Okay.
And it's precisely the kind of question a value investor should ask. It could be marketing, but it could also signal something about their growth strategy.
Yep.
Are they trying to attract more affluent customers? Perhaps those who are less sensitive to economic downturns. It's another piece of the puzzle.
Okay, so we're digging into their financials, looking for signs of stability and smart risk management.
Mm-hmm.
But Graham also talked about looking for companies with a consistent dividend record. How does that apply to a bank like AU?
Right.
Which might not necessarily issue dividends in the same way as a traditional company.
You're right. That's one area where we need to adapt Graham's thinking.
Okay.
Instead of dividends, we might look at their history of profitability.
Okay.
Are they consistently generating earnings? And how are they using those earnings? Are they reinvesting in growth, strengthening their financial position, or perhaps buying back shares?
Okay.
It's about understanding their capital allocation strategy.
So it's not just about making money, it's about how they're using the money they make. Right. Are they being responsible stewards of their capital?
Exactly. And this leads us to another key metric Graham used.
Okay.
The price-to-earnings ratio.
Mm-hmm.
It's a way to see if the stock market is valuing a company's earnings fairly. However, banks often have different valuation metrics compared to other industries.
Okay, so what are some alternative metrics we might use to assess AU Small Finance Bank's valuation in the context of the Indian market?
Metrics like price-to-book ratio could be helpful. It compares the market value of the bank to its book value,
Okay.
which is essentially the net worth of the bank's assets.
Uh-huh.
Another key metric is return on equity. This tells us how effectively they're using their shareholders' money to generate profits.
Okay.
The point is, the tools need to fit the job.
It's making me think back to those Reddit users who questioned if the intelligent investor is still relevant.
Right.
Maybe it's not about the exact formulas, but the overall approach.
Yeah.
Like having a mental toolkit to analyze any business, even if the specifics change.
That's a fantastic way to put it.
Yeah.
It's like having a set of high-quality tools,
Right.
like a hammer, a screwdriver, a wrench.
Yeah.
They're incredibly useful.
Uh-huh.
But you need to know which tool to use for each task. Blindly following a formula without understanding the context can be disastrous.
So it's about adapting, evolving, and applying these principles thoughtfully.
Exactly.
You know, that reminds me of something else Graham mentioned, net working capital.
Yeah.
Essentially, it's about finding companies trading for less than the value of their easily sellable assets.
Right.
But how does that apply to a bank? Their assets aren't like inventory you can just liquidate, right?
Right. It's a very conservative approach that Graham used, and it might not be directly applicable to a financial institution like AU.
Okay.
Instead of looking for physical assets,
Yeah.
we'd focus on the quality of their loan portfolio. Are those loans likely to be repaid?
Okay.
We'd also look at their capital adequacy ratios, essentially their financial cushion, to absorb potential losses.
Huh.
It's about applying the principle of seeking a margin of safety,
Right.
but doing so in a way that makes sense for the banking industry.
It's fascinating how these seemingly rigid formulas can be transformed into flexible principles that can be applied across different sectors.
Absolutely.
It really highlights the adaptable nature of the value investing mindset.
It does.
Now, thinking about AU's diverse offerings, from basic savings accounts to that green fixed deposit we mentioned, it seems they're trying to appeal to a wide spectrum of customers.
Mm-hmm.
What are your thoughts on that strategy?
It's like they're casting a wide net,
Okay.
trying to attract customers with different needs and financial goals. That green fixed deposit is particularly interesting.
Right.
It seems to align with the growing focus on sustainability and responsible investing, which could attract a certain type of customer.
Yeah.
And then you have programs like Royale, which seems tailored for high net worth individuals.
Mm-hmm.
It's quite a diverse portfolio of offerings.
But is that a good thing? Does it make them more resilient, or does it spread their focus too thin?
That's a question we'd need to explore further.
Okay.
It could make them more resilient if they manage each segment effectively. However, if they try to be everything to everyone and don't excel in any particular area, it could backfire.
Okay, so we've got to look beyond the surface, see if they're genuinely serving each customer segment well, or if it's just a marketing facade.
Exactly.
This is getting me really excited about the world of financial analysis.
That's great.
But I'm just one person.
Yeah.
What about our listener out there? What do you hope they're taking away from our conversation so far?
I hope they're starting to see the value in thinking like an investor, even if they're not managing millions of dollars.
Right.
These principles can help you make more informed decisions about your own finances, whether it's choosing a bank, evaluating an investment opportunity,
right,
or simply understanding the forces that shape the financial world around us.
It's like we're giving them a secret decoder ring to unlock the mysteries of finance.
I like that.
But it's not just about the numbers, right? Graham also talked a lot about the importance of understanding investor psychology.
Yes.
Of not letting our emotions get the best of us.
Absolutely. Remember that quote we mentioned earlier? The investor's chief problem, and even his worst enemy, is likely to be himself.
Right.
We all have biases.
Yeah.
We all make emotional decisions, and understanding those tendencies is crucial for making sound financial choices.
So it's not just about having the right knowledge, it's about having the right mindset.
Exactly.
And that's something we can all work on, right?
Absolutely. It's a continuous journey of learning, of self-awareness.
Right.
And of developing the discipline to stick to our plans, even when the market gets turbulent.
Speaking of turbulence, another thing Graham highlighted was the difference between investing and speculating.
Okay.
He wasn't a fan of trying to time the market or make quick bets based on rumors.
Yeah.
How does that apply to a company like AU Small Finance Bank? Would looking at their stock price be considered speculation?
Not necessarily. The key is your approach and your mindset.
Okay.
If you're solely focused on short-term price fluctuations,
right,
trying to time the market and make a quick profit, that's likely speculation.
Okay.
But if you're doing your research, understanding their fundamentals, their long-term growth potential, and assessing whether the market price reflects that potential, then you're aligning more with the principles of intelligent investing.
So it's about being a detective, not a gambler.
Exactly.
It's about looking for evidence, not relying on luck.
Precisely. And this ties back to the concept of margin of safety.
Okay.
It's about protecting yourself from the unknowns, from the inevitable fluctuations of the market.
But with a bank like AU, how do you even assess that margin of safety? Their business is more complex than, say, a manufacturing company.
That's where the analysis gets more intricate.
Okay.
We'd need to consider factors like their exposure to different economic sectors, the quality of their loan book, their underwriting standards, are they lending responsibly?
Right.
And we look at their capital adequacy ratios. Are they well capitalized to weather potential losses?
Okay, so we're looking for signs that they're not taking excessive risks, that they're prepared for the unexpected. It's like checking their financial airbags before getting in the car.
Yeah. Exactly. It's about understanding how well equipped they are to navigate the inevitable bumps in the road.
You know, this makes me think about those Reddit users who argued that the intelligent investor is outdated. It seems like they might be missing the forest for the trees.
Yeah.
The specific formulas might need tweaking.
Right.
But the underlying principles of analyzing a business, understanding its intrinsic value, and managing risk, those seem more relevant than ever.
Absolutely. It's about having that mental framework to approach any investment decision, whether it's a single stock or a whole bank.
So it's not about memorizing a set of rules.
Mhm.
It's about cultivating a mindset that allows you to adapt and make sound judgments in any situation.
Precisely. And that's why this conversation is so important.
Yeah.
It's not about giving a set of answers.
Right.
It's about sparking curiosity, encouraging questions, and empowering you, the listener, to become a more informed and confident participant in the financial world.
It's about giving you the tools and the mindset to navigate the complexities of finance, whether you're a seasoned investor or just starting your journey.
And speaking of journeys, I think AU Small Finance Bank is on an interesting one, trying to cater to the evolving financial needs of the Indian population.
They're offering this blend of traditional banking services with innovative digital solutions.
Yes.
That seems to be a winning combination in a rapidly changing market like India.
And their focus on accessibility, convenience, and personalized services aligns with the growing demand for a more customer-centric banking experience.
And don't forget their expansion into specialized loan products like that AU Green Fixed Deposit. It shows they're aware of emerging trends and are trying to cater to a more environmentally conscious customer.
It's like they're not just following the market, they're trying to anticipate it to stay ahead of the curve and position themselves for long-term growth.
And that's a key characteristic of successful businesses, isn't it?
Absolutely.
The ability to adapt, to innovate, and to anticipate the needs of their customers.
It's about having a vision for the future and taking proactive steps to achieve it.
And that's something we can all learn from, whether we're running a business, managing our finances, or simply navigating the complexities of the modern world.
It's about embracing change, seeking opportunities, and constantly striving to improve our understanding and our approach.
You know, all this talk about AU's strategy and growth potential is making me think, are they walking the walk when it comes to Graham's principles?
That's a brilliant question.
Are they being as intelligent with their own capital allocation as we're trying to be as investors looking at them?
And it goes to the heart of what we're discussing. We can't know for sure without being inside their boardroom.
Right.
But we can look for clues.
Okay.
Are they reinvesting wisely? Are they acquiring other companies that add value?
Uh-huh.
Are they avoiding unnecessary risks or getting caught up in hype-driven investments?
So it's like holding them to the same standards that Graham would use. Are they truly thinking like long-term owners building a sustainable and valuable business?
Exactly. And remember, a company can talk a big game about responsibility and growth, but the proof is in their actions.
It's like that old saying, actions speak louder than words.
Yeah.
We've got to look beyond the marketing spin and see if their decisions align with their stated values.
You're hitting on a crucial point.
Yeah.
And it's something Graham emphasized as well.
Okay.
He stressed the importance of looking at the management team,
Okay.
their track record, and their ethics.
Uh-huh.
Are they honest?
Yeah.
Are they competent?
Right.
Do they have a long-term vision, or are they just chasing short-term profits?
It's like evaluating a captain before getting on their ship. Do they have the skills and experience to navigate through rough seas?
That's a great analogy.
Right.
And with AU Small Finance Bank, we'd want to look at their leadership. Who are they?
Okay.
What's their background? Have they made sound decisions in the past? Are they committed to building a sustainable and ethical business?
Okay. So we're adding another layer to our investigation. It's not just about the numbers. It's about the people behind the numbers.
Exactly.
It's about understanding their motives, their values, and their ability to execute their vision.
Precisely. And this is where our understanding of the Indian market and its unique dynamics becomes crucial.
Okay.
We need to assess whether AU's leadership team understands the nuances of this market, its challenges and opportunities.
So it's not just about applying Graham's principles in a vacuum.
Right.
It's about understanding the context of the specific environment in which the company operates.
Absolutely. It's about connecting the dots, integrating our knowledge of value investing with our understanding of the specific business and its environment.
And that brings us back to the importance of doing our own research.
Yes.
We can't just rely on summaries or secondhand opinions. We need to dig into the details, read their financial statements, analyze their decisions, and form our own conclusions.
Exactly. Graham encouraged investors to go directly to the source to read company reports.
Okay.
To study industry trends.
Right.
It's about being an active participant in the investment process, not a passive bystander.
So we're putting on our detective hats, gathering evidence and building our case. But let's not get too carried away. Remember, we're not giving financial advice here.
Of course not.
This is about exploring how to think like an investor.
Right.
How to apply these principles to any company.
Yes.
And how to make more informed financial decisions in our own lives.
Well said, and I hope our listener is feeling empowered to do just that.
I know, I am. It's like we're unlocking a whole new way of looking at the world, seeing opportunities and risks that we might have missed before.
I think so too. Yeah, it really is. And I think Graham would be pleased to see how we're applying his principles to a company like AU Small Finance Bank, which is operating in a vastly different world than the one he wrote about.
Yeah.
But even with all the changes, the core ideas remain powerful.
Speaking of changes, one thing that keeps coming up for me is the speed of the market today.
Mm-hmm.
It's all about algorithms, high-frequency trading, and making a quick buck.
Yeah.
It feels like the patience and discipline that Graham preached are becoming relics of the past.
It's a valid concern. The market has undoubtedly become faster, more volatile, and driven by technology in ways Graham could never have imagined.
Right.
But I think that's precisely why his principles are even more important today.
Okay.
They provide an anchor, a way to filter out the noise and make sound decisions amidst the chaos.
So how can a value investor thrive in this environment without getting swept up in the frenzy?
Right.
It's easy to feel like you need to be constantly buying and selling,
Yeah.
reacting to every headline and tweet.
I think it comes back to what we were talking about earlier, focusing on what you can control.
Okay.
You can control your own research, your investment strategy, and your emotional response to market fluctuations. Don't get caught in the trap of trying to outsmart the algorithms or predict every market move.
Right.
Focus on understanding the businesses you're interested in, their intrinsic value, and let the market noise fade into the background.
That's such a great point. It's like tuning out the static on the radio to hear the music more
Yeah,
clearly. But even if you're not trying to play the high-frequency trading game, there's another challenge. The sheer volume of information available today.
Right.
It's overwhelming.
It is.
How do you even know where to start, what to trust, and what to ignore?
You're absolutely right. We're bombarded with news, opinions, and data from every direction. It can feel like drinking from a fire hose. But I think there are ways to manage this information overload.
Okay.
First, be discerning about your sources. Stick to reputable financial publications, industry reports, and the company's own financial statements. Don't get caught up in rumors or speculative hype from unverified sources.
And even with those seemingly credible sources, it's important to remember that everyone has a bias, right?
Absolutely.
Is there a hidden agenda? Are they trying to sell you something?
Exactly. Always think critically about the information you're consuming, who's presenting it, and what might their motives be. And second, don't try to consume everything. Focus on the information that's relevant to your investment strategy and the companies you're interested in. Don't let the fear of missing out lead you down a rabbit hole of irrelevant data.
It's about being selective, prioritizing quality over quantity, not letting yourself get bogged down in the minutia.
Precisely. And third, don't be afraid to seek out different perspectives.
Okay.
Read analyst reports from various firms, listen to interviews with industry experts, and consider different viewpoints before forming your own conclusions.
It's like getting a second opinion from a doctor. You want to make sure you're getting a well-rounded view of the situation before making any major decisions.
That's a great analogy, and this all ties back to the importance of critical thinking, which is a key principle that Graham emphasized throughout The Intelligent Investor.
He really wanted investors to be independent thinkers, not just blindly following the crowd or accepting information at face value.
He wanted us to question assumptions, to analyze the data, and to form our own conclusions based on sound reasoning and careful consideration.
It's about being a detective, piecing together the evidence and forming our own judgments about a company's true worth.
And this brings us back to one of Graham's most powerful analogies, the idea of Mr. Market. Remember, he envisioned the market as a manic, depressive fellow who's constantly offering to buy or sell you stocks, often at prices that have little to do with the underlying value of the businesses.
It's such a brilliant way to illustrate how irrational the market can be driven by fear and greed rather than logic and analysis.
Exactly. And Graham's advice was to not get caught up in Mr. Market's emotional swings, but to focus on the intrinsic value of the companies you're interested in. Recognize that the market is not always right, that prices can fluctuate wildly in the short term, and that these fluctuations are often driven by emotions rather than sound judgment.
So it's about staying focused, disciplined, and patient, and recognizing that opportunities will arise when Mr. Market becomes overly pessimistic and offers you bargains, or when he becomes overly optimistic and offers you a chance to sell.
Precisely, and that's where the concept of margin of safety becomes so crucial.
Okay.
It's about protecting yourself from the inevitable downturns, from those moments when Mr. Market loses his mind and offers you ridiculous prices.
It's like having a buffer, a cushion to absorb the impact when the market throws you a curveball.
Exactly. And this brings us back to AU Small Finance Bank. They're operating in a dynamic and often unpredictable market. How do you think they're navigating these challenges? Are they staying true to the principles we've been discussing?
Well, they're certainly facing the same headwinds as any business in today's complex world. But what's impressive is their commitment to innovation, their focus on customer centricity, and their efforts to promote financial inclusion.
They're not just reacting to market forces, they're trying to shape them.
Right.
They're anticipating the needs of their customers and creating solutions that are ahead of the curve.
And that's what sets successful businesses apart, isn't it?
It is.
The ability to adapt, to innovate, and to constantly evolve to stay ahead of the competition.
It's about having a vision for the future and taking proactive steps to make that vision a reality.
And that's a lesson we can all apply, whether we're running a business, managing our personal finances, or simply navigating the complexities of the modern world.
It's about embracing change, seeking opportunities, and constantly striving to improve our understanding and approach.
You know, all this talk about AU's strategy and growth potential is making me think, are they walking the walk when it comes to Graham's principles? Are they being as intelligent with their own capital allocation as we're trying to be as investors looking at them?
That's a brilliant question, and it goes to the heart of what we're discussing. We can't know for sure without being inside their boardroom, but we can look for clues. Are they reinvesting wisely? Are they acquiring other companies that add value? Are they avoiding unnecessary risks or getting caught up in hype-driven investments?
So it's like holding them to the same standards that Graham would use. Are they truly thinking like long-term owners, building a sustainable and valuable business?
Exactly. And remember, a company can talk a big game about responsibility and growth, but the proof is in their actions.
It's like that old saying, actions speak louder than words.
Mm.
We've got to look beyond the marketing spin and see if their decisions align with their stated values.
You're hitting on a crucial point, and it's something Graham emphasized as well. He stressed the importance of looking at the management team, their track record, and their ethics. Are they honest? Are they competent? Do they have a long-term vision, or are they just chasing short-term profits?
It's like evaluating a captain before getting on their ship. Do they have the skills and experience to navigate through rough seas?
That's a great analogy, and with AU Small Finance Bank, we'd want to look at their leadership. Who are they? What's their background? Have they made sound decisions in the past? Are they committed to building a sustainable and ethical business?
Okay, so we're adding another layer to our investigation. It's not just about the numbers. It's about the people behind the numbers. It's about understanding their motives, their values, and their ability to execute their vision.
Precisely. And this is where our understanding of the Indian market and its unique dynamics becomes crucial.
Okay.
We need to assess whether AU's leadership team understands the nuances of this market, its challenges and opportunities.
So it's not just about applying Graham's principles in a vacuum. It's about understanding the context, the specific environment in which the company operates.
Absolutely. It's about connecting the dots, integrating our knowledge of value investing with our understanding of the specific business and its environment.
And that brings us back to the importance of doing our own research. We can't just rely on summaries or secondhand opinions. We need to dig into the details, read their financial statements, analyze their decisions, and form our own conclusions.
Exactly. Graham encouraged investors to go directly to the source, to read company reports, to study industry trends. It's about being an active participant in the investment process, not a passive bystander.
So we're putting on our detective hats, gathering evidence, and building our case. But let's not get too carried away. Remember, we're not giving financial advice here. This is about exploring how to think like an investor, how to apply these principles to any company, and how to make more informed financial decisions in our own lives.
Well said, and I hope our listener is feeling empowered to do just that.
I know, I am. It's like we're unlocking a whole new way of looking at the world, seeing opportunities and risks that we might have missed before. It's funny, before we started this deep dive, I thought value investing was just about finding cheap stocks.
Uh-huh.
But it's so much more than that, isn't it?
It is.
There's a whole philosophy, a way of thinking about risk,
Right.
about opportunity, and about building long-term value.
It truly is, and I think Graham would be pleased to see how we're applying his principles to a company like AAU Small Finance Bank, which is operating in a vastly different world than the one he wrote about. But even with all the changes, the core ideas remain powerful.
Speaking of changes, one thing that keeps coming up for me Is the speed of the market today. It's all about algorithms, high-frequency trading, and making a quick buck. It feels like the patience and discipline that Graham preached are becoming relics of the past.
It's a valid concern. The market has undoubtedly become faster, more volatile, and driven by technology in ways Graham could never have imagined. But I think that's precisely why his principles are even more important today. They provide an anchor,
Okay.
a way to filter out the noise and make sound decisions amidst the chaos.
So how can a value investor thrive in this environment without getting swept up in the frenzy? It's easy to feel like you need to be constantly buying and selling, reacting to every headline and tweet.
I think it comes back to what we were talking about earlier, focusing on what you can control. You can control your own research, your investment strategy, and your emotional response to market fluctuations. Don't get caught in the trap of trying to outsmart the algorithms or predict every market move. Focus on understanding the businesses you're interested in, their intrinsic value, and let the market noise fade into the background.
That's such a great point. It's like tuning out the static on the radio to hear the music more clearly. But even if you're not trying to play the high-frequency trading game, there's another challenge. The sheer volume of information available today.
Right.
It's overwhelming. How do you even know where to start, what to trust and what to ignore?
You're absolutely right. We're bombarded with news, opinions, and data from every direction. It can feel like drinking from a fire hose. But I think there are ways to manage this information. First, be discerning about your sources.
Okay.
Stick to reputable financial publications, industry reports, and the company's own financial statements. Don't get caught up in rumors or speculative hype from unverified sources.
And even with those seemingly credible sources, it's important to remember that everyone has a bias, right?
Absolutely.
Is there a hidden agenda? Are they trying to sell you something?
Exactly. Always think critically about the information you're consuming, who's presenting it, and what might their motives be. And second, don't try to consume everything. Focus on the information that's relevant to your investment strategy and the companies you're interested in. Don't let the fear of missing out lead you down a rabbit hole of irrelevant data.
It's about being selective, prioritizing quality over quantity, not letting yourself get bogged down in the minutia.
Precisely. And third, don't be afraid to seek out different perspectives.
Okay.
Read analyst reports from various firms, listen to interviews with industry experts, and consider different viewpoints before forming your own conclusions.
It's like getting a second opinion from a doctor. You want to make sure you're getting a well-rounded view of the situation before making any major decisions.
That's a great analogy, and this all ties back to the importance of critical thinking, which is a key principle that Graham emphasized throughout The Intelligent Investor.
He really wanted investors to be independent thinkers, not just blindly following the crowd or accepting information at face value.
He wanted us to question assumptions, to analyze the data, and to form our own conclusions based on sound reasoning and careful consideration.
It's about being a detective, piecing together the evidence and forming our own judgments about a company's true worth.
And this brings us back to one of Graham's most powerful analogies, the idea of Mr. Market. Remember, he envisioned the market as a manic, depressive fellow who's constantly offering to buy or sell you stocks, often at prices that have little to do with the underlying value of the businesses.
It's such a brilliant way to illustrate how irrational the market can be driven by fear and greed rather than logic and analysis.
Exactly. And Graham's advice was to not get caught up in Mr. Market's emotional swings, but to focus on the intrinsic value of the companies you're interested in. Recognize that the market is not always right, that prices can fluctuate wildly in the short term, and that these fluctuations are often driven by emotions rather than sound judgment.
So it's about staying focused, disciplined, and patient, and recognizing that opportunities will arise when Mr. Market becomes overly pessimistic and offers you bargains, or when he becomes overly optimistic and offers you a chance to sell.
Precisely, and that's where the concept of margin of safety becomes so crucial. It's about protecting yourself from the inevitable downturns, from those moments when Mr. Market loses his mind and offers you ridiculous prices.
It's like having a buffer, a cushion to absorb the impacts when the market throws you a curveball.
Exactly. And this brings us back to AU Small Finance Bank. They're operating in a dynamic and often unpredictable market. How do you think they're navigating these challenges? Are they staying true to the principles we've been discussing?
Well, they're certainly facing the same headwinds as any business in today's complex world. But what's impressive is their commitment to innovation, their focus on customer centricity, and their efforts to promote financial inclusion.
They're not just reacting to market forces, they're trying to shape them. They're anticipating the needs of their customers and creating solutions that are ahead of the curve.
And that's what sets successful businesses apart, isn't it? The ability to adapt, to innovate, and to constantly evolve to stay ahead of the competition.
It's about having a vision for the future and taking proactive steps to make that vision a reality.
And that's a lesson we can all apply, whether we're running a business, managing our personal finances, or simply navigating the complexities of the modern world.
It's about embracing change, seeking opportunities, and constantly striving to improve our understanding and approach.
So as we wrap up this deep dive into the intelligent investor in AU Small Finance Bank, what are some final thoughts you'd like to leave our listener with?
I'd say don't be intimidated by the world of finance. The principles of intelligent investing are timeless and accessible to anyone willing to put in the effort. It's about shifting your mindset from speculation to ownership, from short-term gains to long-term value creation.
It's about doing your research, understanding the businesses you're investing in, and seeking that margin of safety to protect yourself from the inevitable ups and downs of the market.
Stay disciplined, patient, and focused on your long-term goals even when the market gets crazy. And remember, investing is not just about making money. It's about aligning your financial decisions with your values and building a better future for yourself and the world around you.
That's a powerful message.
Yeah.
So keep learning, keep exploring, and keep striving to become those intelligent investors, informed consumers, and conscious citizens we've been talking about. Because the power to create a better financial future lies within each of us. We just need to embrace it, nurture it, and use it wisely. Thanks for joining us on this deep dive.
Welcome back to the deep dive. Today we're tackling kind of a fascinating challenge. You've given us The Intelligent Investor by Benjamin Graham, the Bible of value investing.
Right.
But you've also thrown in kind of a curveball with AU Small Finance Bank's website.
Okay.
So our deep dive mission is this. Can we actually apply these 70-year-old investing principles to a modern digital bank in India?
Well, that's a question that really cuts to the heart of, whether value investing is truly timeless or whether it's become kind of a relic of a bygone era.
Okay, so first things first, we need to make sure we've got a solid understanding of what value investing actually is.
Right.
Then we can start exploring AU Small Finance Bank and see if we can connect the dots.
Sounds good.
All right.
So to put it simply, value investing is about finding those hidden gems in the market.
Right.
Stocks that are trading for less than what they're actually worth.
So it's like finding a diamond in the rough, except instead of a sparkling gem, it's a company with the potential for, serious growth.
Exactly. And the reason these diamonds exist is because the market isn't always perfectly rational. Prices can be influenced by short-term news, emotions, even just plain old herd mentality.
So the value investor swoops in, buys these undervalued stocks, and then, crucially, holds on to them for the long haul.
That's right. Patience is key. Value investing is not about chasing quick profits or trying to time the market. It's about recognizing that intrinsic value and believing that eventually the market will catch up.
Now, Graham talks a lot about this idea of mean reversion, which sounds pretty technical.
Yeah.
Can you break that down for us in a way that, even I can understand?
Well, think of it like a pendulum swinging back and forth. The market might overreact in the short term, pushing a stock's price too high or too low. But over time, that pendulum tends to swing back towards the center, towards the stock's true value.
So the value investor is betting on that swing back towards the center.
Precisely. They're essentially saying, I believe this company is worth more than what the market is currently giving it credit for. And eventually, the market will recognize that too.
Now, I'm starting to see how this long-term perspective really ties into the whole value investing philosophy. But how do you actually determine if a stock is undervalued in the first place? Is there some, secret formula?
Well, Graham did develop some formulas for calculating intrinsic value. But he always emphasized that these were just tools, not guarantees.
So no magic bullet.
Afraid not. He believed that thorough research and analysis were crucial. You need to understand the company's business, its financials, its management team, its competitive landscape.
It's about looking beyond the hype and really digging into the fundamentals.
Exactly. And even with all that research, you're bound to make mistakes. Which is why Graham introduced this incredibly important concept, the margin of safety.
Okay, the margin of safety. Now that sounds like something I definitely want in my investing toolkit.
It's essentially a buffer against human error and market unpredictability. By buying a stock at a significant discount to its intrinsic value, you're giving yourself room for error.
So even if my analysis is a bit off, or if the market takes an unexpected dip, I'm less likely to get burned.
That's the idea. The margin of safety acts as a cushion, helping you minimize losses and sleep better at night.
I like the sound of that. Now, you mentioned Graham developed some formulas for calculating intrinsic value. Can you give us a quick, glimpse into how those work?
Sure. His original formula focused on a company's earnings and assets. Basically, it tries to determine the present value of the future earnings a company is expected to generate. He later revised the formula to account for interest rates and growth potential.
I'm not a math whiz, but it sounds like these formulas are all about trying to get a realistic estimate of what a company is actually worth, rather than just relying on the market's, often fickle opinion.
That's the essence of it. And the key takeaway here is that these formulas are starting points, not definitive answers. They're meant to guide your research, not replace it.
Got it. So we've laid out the fundamentals of value investing, finding undervalued stocks, taking a long-term perspective, understanding the importance of the margin of safety. But The Intelligent Investor was written back in 1949. The world has changed a lot since then. How relevant are these ideas in today's market, especially when it comes to a digital bank like AU Small Finance?
That's the million-dollar question, isn't it? And it's what makes this deep dive so intriguing. We're going to take these principles, test them against the realities of a modern financial institution, and see what we discover.
All right, so we've got Graham's wisdom in our back pocket. Now let's step into the world of AU Small Finance Bank. From what I'm seeing on their website, they've got a pretty diverse range of offerings.
Yeah, it's quite the financial buffet. Savings accounts, checking accounts, fixed deposits, loans for just about everything, and of course, a heavy emphasis on digital banking.
Yeah, their website practically screams convenience. Net banking, WhatsApp banking, even missed call banking.
Yeah.
They seem to be targeting, those of us who are constantly on the move.
Which is a pretty smart strategy,
Yeah.
considering the increasingly fast-paced lives most people lead these days. But it also raises the question, would Graham, with his emphasis on deep research and careful consideration, approve of this level of convenience?
Good point. It's almost like there's a tension there, isn't there, between making financial services readily available and ensuring that people aren't making, impulsive decisions.
Exactly. I think Graham would argue that convenience shouldn't come at the expense of prudence.
So how do we reconcile these seemingly conflicting ideas? How can we be both, tech-savvy and intelligent investors in the Graham sense?
Well, let's start by looking at how some of AU's specific offerings might align with Graham's principles. For example, he was a big advocate for investing in bonds because of their predictable returns and relative safety.
And that makes me think of their fixed deposits. You lock in a fixed interest rate for a set period of time, kind of like a bond, right?
Precisely. While not identical, they share that underlying principle of seeking stable, predictable returns. It's a way to protect your capital and generate a steady stream of income.
So that's one potential connection, but what about stocks? Graham was all about picking individual stocks based on in-depth analysis. How does that fit into AU's offerings?
Well, they do offer mutual funds. Now, Graham was a bit wary of actively managed funds, where you're relying on a fund manager's stock-picking skills. He believed that individual investors, armed with the right knowledge, could often do better on their own.
But wouldn't he have been a fan of index funds? The ones that passively track a specific market index?
That's where it gets interesting. Index funds weren't really a thing back in Graham's day. But I think he would have appreciated their low fees and their ability to deliver broad market exposure. In a way, they align with his idea of diversification.
So even though AU offers both actively managed funds and index funds, a true Graham disciple would probably stick with the index funds.
Most likely. They offer that balance between diversification and a hands-off approach.
Okay, I'm starting to see how some of the pieces fit together, but there's one thing I'm still curious about. The AU Royale program. It's this premium service with exclusive benefits for certain customers. What do you make of that?
It's an intriguing element. It seems to be targeting a more discerning clientele, perhaps those who are more actively involved in managing their wealth.
So maybe it's aimed at those intelligent investors who want more personalized services and insights.
It's possible. It'll be interesting to delve deeper into the specifics of the Royal program and see if it offers any features or tools that might resonate with a value investing approach.
We've been talking a lot about the potential alignment between AU Small Finance Bank and Graham's principles, but there's also this underlying tension, right?
You're referring to the convenience factor again?
Exactly. On the one hand, their digital focus makes managing your finances incredibly easy. But on the other hand, could that ease of access lead to impulsive decisions?
It's a valid concern. Graham was all about being deliberate and avoiding emotional reactions in the market. He'd probably caution against making investment decisions based solely on what's convenient or trendy.
So, what's the takeaway here for our listener? How can they navigate this complex landscape and make informed choices that align with both their needs and their investment philosophy?
I think it boils down to a few key points. First, don't be afraid to embrace technology. It can be a powerful tool for managing your finances and staying informed.
But always use it with a critical eye. Don't let convenience override your due diligence.
Right. Remember Graham's core principles. Do your research, understand the risks, and don't chase quick profits. And perhaps most importantly,
Think for yourself. Don't blindly follow the crowd or get swept up in market hype.
exactly. Whether you're exploring fixed deposits, mutual funds, or even those fancy Royale perks, approach your financial decisions with a healthy dose of skepticism and a commitment to long-term thinking.
I think Graham would approve of that approach. Now, before we wrap up, I want to circle back to something we touched on earlier, this idea of ownership. Graham believed that a stock wasn't just a ticker symbol on a screen. It represented a piece of a real business.
That's a crucial point, especially in today's world of instant transactions and algorithmic trading. It's easy to lose sight of the fact that you're not just buying and selling numbers. You're investing in companies with real products, real services, and real people behind them.
So the question for our listener is this. In a world dominated by digital convenience, can that sense of ownership still exist? Can you be both a tech-savvy investor and a truly intelligent one in the Graham sense?
I think the answer is a resounding yes, but it requires a conscious effort. It means looking beyond the flashy interfaces and the promises of quick returns. It means understanding the businesses you invest in, believing in their long-term potential, and holding on to them through the inevitable ups and downs of the market.
And that, my friends, is the essence of being an informed investor in the 21st century. It's about taking the best of both worlds, the enduring wisdom of the past and the powerful tools of the present, and forging your own path towards financial success.
So as you continue your deep dive into both value investing and AU Small Finance Bank's offerings, remember to stay curious, question assumptions, and above all, think for yourself.
Thanks for joining us on this deep dive into the world of value investing and AU Small Finance Bank. We hope you found it insightful and maybe even a little bit inspiring.
Until next time, keep learning, keep exploring, and as always, happy investing.
Well, it feels like we've covered a lot of ground here, from the fundamentals of value investing to the nuances of AU Small Finance Bank's digital offerings.
Yeah, it's been quite the journey, hasn't it? We've explored those timeless principles of Benjamin Graham and tried to see how they might apply to a modern financial landscape he could have scarcely imagined.
And I think the key takeaway here is that while the world of investing has certainly evolved, those core principles, thorough analysis, a margin of safety, a long-term perspective are still incredibly relevant.
Absolutely. Whether you're considering a fixed deposit with its predictable returns, an index fund that mirrors the market, or even, diving into individual stock picking, those principles can really guide your decision-making.
And it's that emphasis on informed decision-making that connects a 1949 investing classic to a modern Indian bank.
It's about empowering yourself with knowledge, understanding the risks and rewards, and making choices that really align with your individual goals and risk tolerance.
So as you continue your exploration of both value investing and AU Small Finance Bank, remember that it's not about finding a one-size-fits-all solution.
Right. It's about taking the time to understand the principles, applying them to your specific situation, and making thoughtful choices that set you up for long-term financial success.
And who knows, maybe that's what being an intelligent investor in the 21st century is all about.
It's about, blending the wisdom of the past with the tools of the present and navigating the complexities of the financial world with, both confidence and a healthy dose of skepticism.
Well said. Thanks for joining us on this deep dive into the world of value investing and AU Small Finance Bank. We hope you found it insightful and maybe even a little bit inspiring.
Until next time, keep learning, keep exploring, and as always, happy investing.
Hey everyone, and welcome back for another deep dive.
Excited to be here.
This time we're going to be looking at value investing with the classic book, The Intelligent Investor, by Benjamin Graham.
Oh, a fantastic choice.
Yeah, and we're also going to be taking a look at AU's Small Finance Bank and the services they offer.
Sounds good.
We've got excerpts from the book itself, some interesting reviews and blog posts that we found.
Great.
And then obviously we'll be taking a look at the bank's website.
Excellent sources.
Yeah, it should be pretty interesting to kind of see how all this stuff connects together.
Yeah, looking forward to it. It's interesting because I think we can tie a lot of the investment principles from that book into the modern services that a bank like AU Small Finance offers.
Yeah, for sure. So, okay, let's start with The Intelligent Investor.
Okay.
This book is like legendary status.
Oh, absolutely, yeah.
Even Warren Buffett says it's like the best investing book ever written.
It's a must-read for any investor.
So what is the big deal about value investing? I mean, what is it really all about?
Well, at its core, value investing is about finding those stocks that the market might be undervaluing.
Okay, so like hidden treasures, kind of?
Exactly, like hidden treasures.
Yeah.
It's not about, chasing the latest trends or getting caught up in all the hype.
Right, so less FOMO, more like doing your research.
Exactly.
Yeah.
It's about really understanding the business, the fundamentals, like their assets, earnings, dividends, their potential for growth.
So instead of just looking at like, a ticker symbol on a screen, I should be thinking like, would I want to buy this entire company?
Precisely. You need to think like a business owner.
Okay, I like that.
Now, Benjamin Graham, he introduced some really important concepts in the book that can help investors, with that kind of evaluation.
Okay.
Have you ever heard of the margin of safety?
I feel like I've heard of it, but I don't really remember what it is.
Okay, well, it's the idea that you should be buying stocks below their intrinsic value. So their actual worth.
Okay.
That difference, that discount, it acts like a buffer against potential losses.
So it's like a safety net in case like the market, takes a dip or something.
That's a great way to put it. It's like a buffer or a cushion.
Okay.
Then there's the concept of Mr. Market.
Mr. Market. Who is this guy?
Well, Mr. Market is how Graham personifies the stock market. He's known to be a bit moody.
Yeah.
He swings from like wild optimism to like really deep despair.
Oh, so he's kind of all over the place.
Yeah, and often acting irrationally.
That sounds stressful.
Well, the point is a smart investor doesn't let Mr. Market's mood swings control their decisions.
Okay.
So, like when everyone is panicking and selling, a value investor would ask, has the intrinsic value of the company actually changed?
That's a good point.
And if it hasn't, then that might be a good opportunity to buy.
Don't let your emotions get the best of you.
Right. Emotions can be a dangerous thing when it comes to investing.
Okay.
Now, Graham also talked about two different types of investors.
Yeah.
The defensive investor and the enterprising investor.
Okay, tell me about these two. Which one am I?
Well, the defensive investor is someone who's a little bit more risk averse.
Sure.
They prefer a simpler approach. Maybe focusing on a diversified portfolio of index funds. Whereas the enterprising investor is willing to put in more time and effort.
Oh, okay.
They're actively seeking out those undervalued individual stocks, doing deep company analysis.
Okay.
So one better than the other?
Yeah, is one better?
Not necessarily. It really depends on your personal circumstances, risk tolerance, and how much time and effort you're willing to put in.
That makes sense.
Both can be successful if done right.
Now let's address the elephant in the room.
Okay.
This book was written in 1949.
Yeah, it's an old one.
Does it even still apply today?
Well, that's a great question.
Yeah.
Some people argue that certain aspects might be a little outdated.
Okay.
Especially when you think about all of the, modern companies and how much the financial world has changed.
Right.
However, I think the core principles, like focusing on fundamentals, avoiding emotional decisions, and having that long-term perspective, those are still as relevant as ever.
Yeah, I could see that. It's like fashion, trends come and go, but certain style principles are kind of always there.
Exactly. The fundamentals never go out of style.
Okay, so speaking of fundamentals, I know Graham gives some formulas to calculate a stock's intrinsic value.
He does.
I'm not a math person at all, so can you just give like the main takeaway there without getting into all the numbers?
Sure, yeah, you don't need to be a math whiz.
Okay, good.
The main point is that he provides concrete, methodical ways to try and estimate a stock's worth.
Okay.
So it's about taking emotion out of the equation and really looking at the numbers.
Got it. Now, you also brought some book reviews and blog posts.
I did.
What were some of the key takeaways from those?
Well, a lot of them emphasize the importance of patience and thinking long-term.
Okay.
One of the reviews said that, statistically speaking, the less you tinker with your portfolio, the better off you'll be in the long run.
Oh, that's going to be tough for me.
It's hard.
I always want to react to every little thing that's happening.
It's tempting, but that can actually hurt your returns because of transaction costs and taxes and all that.
Okay.
Sometimes it's better to ride out those short-term ups and downs and think about where you want to be years down the line.
Long-term vision.
Exactly. Another point they made was about staying objective and not letting emotions drive your decisions.
Oh, that's easier said than done.
Oh, absolutely. One blog post even said to avoid speculation driven by fear or greed.
Yeah. We all know Mr. Market is emotional, right? we don't have to be.
We can be the calm in the storm.
So how do we avoid getting swept up in all that?
It's about doing your own research, carefully evaluating a company, and not letting all the hype of the market, cloud your judgment.
Don't get caught up in the hype.
Yeah. It's easy to do, but you got to stay focused.
Okay.
There was also a point about understanding historical context, but being adaptable.
So don't just get stuck in the past.
Exactly.
Yeah.
What worked, decades ago might need some tweaking today.
Okay.
Markets evolve. New technologies emerge, new industries pop up.
Right.
So the key is to learn from the past, but stay open to new possibilities.
It's like history. Study the past, understand the present, and prepare for the future.
That's a great way to put it. It's about finding that balance between learning from the past and adapting to the present.
Wow. I already feel like I'm thinking about investing in a whole new way.
It's a journey.
No.
It is a journey.
There's always more to learn.
Always more to learn, that's for sure.
Absolutely.
And we're back. So we just finished exploring some of those fascinating concepts from The Intelligent Investor by Benjamin Graham.
Some really great stuff in that book.
Yeah, for sure. So now let's switch gears a little bit and talk about Housel Finance Bank.
Okay, sounds good.
I'm really curious to see if we can connect any of those principles to the services that they offer.
Yeah, I think we can definitely draw some parallels there. Okay, so first of all, just looking at their website, I'm really impressed with the variety of services that they offer.
Yeah, they have a lot going on.
It's like a one-stop shop for all your financial needs.
Right.
They have everything from basic savings accounts to loans, insurance, even investment options.
It's a pretty impressive portfolio.
It is. And they seem to cater to a really wide range of customers, right?
Yeah, they do individuals, businesses, agricultural clients.
So they're really trying to reach a broad audience.
It seems that way.
Okay, so let's break down some of what they offer.
Okay.
Let's start with savings accounts.
All right.
I know they have a bunch of different options.
Yeah, they do. They have the AU digital savings account, which is probably good for people who prefer to do everything online.
Yeah, that's me for sure.
Then they have AU Royal, which looks like it comes with, some extra perks and benefits.
So fancy.
They even have accounts specifically for women, senior citizens, and students.
Oh, wow. So they really have like a tailored approach for different groups of people.
It seems like they've really thought about, what different demographics might need.
Yeah, I like that. Okay, what about fixed deposits?
Fixed deposits. Yeah, those are always popular, for people who are looking for a relatively safe way to earn some interest.
Yeah, for sure.
And AU Small Finance Bank, they seem to have some pretty competitive interest rates.
Yeah, okay.
They even have this Planet First green fixed deposit option.
Oh, what is that?
Yeah, it's for people who want to invest in a more sustainable way.
Oh, I love that. I'm all about those sustainable options.
Yeah, it's great to see companies offering that kind of thing.
Okay, so now let's talk about current accounts for all of our entrepreneurial listeners out there.
Right.
What do they have for businesses?
Well, their main thing is this AU Royal Business Program.
Okay.
It looks like it has a lot of features, and then they have some variations that are tailored to specific types of businesses.
Oh, like what?
Like ones for doctors, agribusinesses, contractors.
So no matter what kind of business you're running, they probably have an account for you?
Most likely. Yeah, they seem to cover a lot of bases.
Okay. And then, of course, they offer loans, too.
Right. Loans are a big part of what they do.
Yeah, and that can be such a big decision for people.
Absolutely.
Whether it's for a home or a car or to, fund their business.
That's a big commitment.
So it's good to see that they have a lot of different options.
Yeah, they have home loans, car loans, gold loans, business loans,
Right.
and really emphasize how you can, track your loan application online.
Oh, that's super convenient.
Yeah, no more waiting around wondering what's going on.
I hate that.
Yeah, it's a much better system.
Okay, now, this is where I think things get really interesting.
What's that?
Their digital banking options.
Oh, yeah. They're really impressive.
They have the AU0101 app, net banking, video banking.
It's pretty cutting edge.
Wait, video banking, is that like you can talk to a banker through video chat on your phone?
That's what it sounds like.
That's amazing.
They're really embracing technology.
Yeah.
And on top of all that, they even have WhatsApp banking and missed call banking.
Missed call banking, what is that?
You can just give them a missed call, and apparently they'll handle your banking for you.
No way. That's incredible.
Technology is wild.
It is. It's amazing how much easier they've made banking,
It really is.
Okay, so we talked about savings accounts. We talked about loans.
Uh-huh.
We got to talk about insurance.
Yes, insurance. That's a key part of financial planning.
For sure. And it looks like they have a really comprehensive offering of insurance products.
Yeah, they do. They have life insurance, health insurance, motor insurance, even some Social Security schemes.
They have everything.
Pretty much.
Okay, and then finally, let's touch on investments.
All right.
I know a lot of our listeners are probably interested in that,
Yeah, for sure. People are always looking for ways to grow their money.
So what kind of investment options do they have?
They have mutual funds, which are always a good option for diversification.
Okay.
And then they have something called the AU Select List, which looks like it's more personalized wealth solutions.
Personalized? That sounds interesting.
Yeah, it does. It seems like it might involve some financial advice and planning.
Oh, that's cool.
Yeah, it could be a good option for people who are looking for more guidance.
Okay, wow. We really covered a lot of ground here.
Yeah, they really do have a lot to offer.
I mean, it's clear that AU Small Finance Bank has a wide range of services to meet a lot of different needs.
They really do.
And I think it'd be interesting to think about how some of those value investing principles that we talked about earlier,
Yes.
could be applied to the choices that we make when we're using these services.
That's a great point. I'm curious to hear your thoughts on that.
Yeah, me too. But before we get into that, what stood out to you the most from everything we just talked about?
That's a good question.
Yeah.
I think for me, it's how they've managed to combine traditional banking services with, all of this new technology.
Yeah, they seem to be embracing innovation while still, keeping that focus on customer service.
Right. And they have physical branches too. So, if you're someone who likes to go in and talk to someone face to face,
Yeah, they have that option too.
it's a good mix.
Yeah, I agree. And they're clearly targeting a diverse clientele,
Definitely.
which I think is really great. It's like financial inclusion.
Everyone's welcome.
Yeah, exactly. No matter where you are in your financial journey.
Right. They're there to help you along the way.
Love that.
Yeah, it's a good message.
Okay, so we've explored the world of AAU, Small Finance Bank, and we've got all these value investing principles, floating around in our heads.
Yeah, it's a lot to take in.
So now in part 3, let's bring it all together.
Okay.
And really see how we can apply these ideas to our own lives. I think this is going to get really interesting.
It's going to be thought-provoking for sure.
All right, we are back for the final part of our deep dive.
The grand finale.
I know, it's amazing how we went from all those value investing ideas from the intelligent investor
Right.
to talking about, a modern bank like AE Small Finance Bank.
Yeah, it's been quite a journey.
So now I think we should try to challenge ourselves and our listeners to actually take those value investing concepts
Yes.
and apply them to other areas of our lives.
I love that idea.
What if we expand that definition of being an intelligent investor
Right.
beyond just, stocks and finances?
Exactly, because a lot of those principles can be applied to so many different things.
Okay, so thinking back to those hidden gems we talked about with stocks,
Yeah.
what are some other hidden gems we might find in our lives
Good question.
if we use that same kind of value investing mindset?
Okay, well, let's start with career choices.
Okay.
A lot of people just chase the highest paying job or the most prestigious title.
Right.
But what if instead of doing that, you focused on finding a role that really aligns with your values? One that offers, opportunities for growth, maybe even a sense of purpose.
Okay, so instead of getting caught up in the hype of a certain career path,
Yeah.
we should be thinking about its intrinsic value to us, how fulfilling it would actually be.
Precisely. And just like you'd want a margin of safety with your investments, you might want to think about, a career path that offers some stability,
Okay.
some resilience,
Yeah.
in case things change unexpectedly.
So it's like having a backup plan, kind of.
Right, or diversifying your income streams.
Okay, I like that.
And remember how Graham talked about the importance of the long game?
Yeah.
Applying that to your career could mean investing in yourself,
Okay.
developing your skills, building relationships, working towards your goals.
Even if it takes time.
Exactly. Even if it takes time. Patience is key.
That's a good reminder for me.
It's easy to get impatient,
Very impatient.
but sometimes those most fulfilling paths, they take a while.
They do. They do. Okay, so we talked about careers.
Okay.
What about relationships?
Oh, relationship.
Could we use a value investing mindset for how we approach, friendships and family and all of that?
I think so. Think about the people in your life who bring you joy, support, encouragement. Those are like the blue chip stocks of your social circle.
Oh, I like that.
The ones that you can always count on.
Yes.
And like you'd want to diversify your investment portfolio.
Yeah.
It's important to have a diverse network of relationships.
Okay, so it's not just about having like one or two really close friends.
No, it's about having a variety of people in your life.
Okay.
People who challenge you, inspire you, offer different perspectives.
So you're building a strong relationship portfolio, basically.
Exactly, one that supports your overall well-being.
I love that. Okay, now here's a tough one.
Okay.
How do we apply this to like our everyday purchases?
Ooh, that is a tough one.
I mean, it's so easy to just like buy things on impulse.
Especially these days with all the online shopping.
So true.
Yeah.
So how do we resist?
Well, what if before you buy something, you ask yourself, does this really align with my values? Will this actually add value to my life, or am I just getting caught up in the moment?
So it's like evaluating the intrinsic value of a purchase.
Yes. Instead of its perceived value or like the hype around it.
Okay. And could we also look for like a margin of safety when we're shopping?
You could. Maybe that means looking for ways to save money
Okay.
without, sacrificing quality.
So like comparing prices, being a more mindful consumer.
Exactly. And, Graham talked about thinking long term.
Yeah.
So maybe sometimes it's better to invest in higher quality items, even if they cost a bit more upfront.
Okay.
Because they'll last longer and you'll save money in the long run.
That's a good point.
Yeah.
I do tend to buy the cheaper option, even if I know it won't last as long.
It's tempting. But sometimes that long-term thinking can save you money.
Wow, this has been so eye-opening.
It's amazing how these principles can apply to so many areas.
It really is. I feel like I'm looking at everything differently now.
That's the goal. It's about making intentional choices.
Yes.
Thinking critically about what matters to you. And aligning your decisions with your goals and values.
And like any investment strategy, it takes practice.
Oh, absolutely.
Patience and a willingness to learn.
It's a journey.
Well, this has been an incredible deep dive. I hope everyone listening is feeling inspired.
Me too.
To apply these ideas to their own lives, not just their finances.
It's about being an intelligent investor in every sense of the word.
That's a great way to put it. So thank you all for joining us on this journey.
It's been a pleasure.
Keep those brains engaged. Keep seeking those hidden gems.
Yes.
And we'll see you next time for another deep dive.